All right, main difference between a 15-year and a 30-year fixed loan, and how does it apply to you? So yeah, you're gonna see a lot of marketing out there where people will say, oh, you should go 15 year, you should go 15 years. It's a shorter term, you're gonna pay it off sooner, right? Well, and don't get me wrong, 15-year rates have some, or 15-year mortgages have some amazing rates. However, that may not always be the best option for you, right? Because here's the deal. On a 30-year fix, especially right now with the markets and the current, the world that we live in with what's been going on for the last 24 plus months, there's a lot of instability and volatility. And a 30-year fixed rate note is going to keep your payments small, and it's going to give you an opportunity to you're going to have to be well qualified to buy that home. Now, you still have to be well qualified to buy a 15-year. However, that payment is almost twice as much as what it would be if you did a 30-year. Now, follow me here. Let's say your 30-year note is $1,000 a month, right? And that same 15-year note is $1,800 a month. So that's about $800 more, right? On, let's say, a $200,000 loan amount, right? Now you can afford the 15-year. The difference is though, remember, you always hear me talk about, are you surviving or are you thriving? Now, at that $1,800 a month, you can pay all your bills. You're not necessarily surviving, but you're not really thriving either. You're kind of somewhere in the middle, right? And God forbid, if something were to happen to where you potentially lose your job, or let's say you're serving and you're asked to get out of service sooner than you expected, that 15-year crunch is going to be a tough pill to swallow, right? Where at least with the 30-year note, let's say you say, hey Jay, you know what? I can still afford to pay more. Well, if you can afford to pay more, you've got the 30-year note, and if you want to be able to pay the 15-year note amount, you can do that. You can actually pay that towards the 30-year, and guess what? You're basically going to do it about the same amount of time. It's going to be maybe a year or two longer than typically going the 15-year route. But here's the good news, is if you get accustomed to that, and then God forbid something does happen to where you can no longer make that $18 a month payment, $1,800 a month payment, you're only on the hook for the $1,000, so it gives you a little bit of financial liquidity. And that's really what your loan advisor should be talking to you about, is what do the numbers look like? Are you going to be just surviving with one and thriving with the other? Or is it a combination there of the two? That's something that a computer can't tell you. You have to have that literally very direct and blunt conversation with your loan advisor, right? So hopefully that helps you out. Hopefully that breaks it down a little bit. And just remember, 15-year isn't always better. It really just depends, right? Other than that, make it a great day.